Welcome back, everybody, to our class on energy trading, portfolio and risk management. This course's topic is an energy utility with a generation asset. So this class is going to be about generating and selling on the wholesale market. We have 5 things to discuss. The first is spreads and profitability of power plants, which is an introduction to the setup. The second major topic is options and optionality. Third topic is flexibility and real options. Fourth topics, markets for flexibility. And fifth, optimizing generation assets. So let's start with a question. Assume you work in a municipality which operates a combined cycle turbine power plant, a CCGT. That is a power plant that generates electricity from natural gas. And your internal controlling department states that the CCGT is technically state-of-the-art and highly efficient, but seems to have been making losses for some time. And here is the question to get us started. Which data would you use to approximately analyze this statement? So you're challenged. We have a modern power plant, but we are making losses. What would you look at? Please think about it for a moment. Okay, let's go through it. What we are interested in is what drives profitability of a power plant. And what does a power plant do if we simplify to the max and just say, well, what a power plant typically does is it burns fuel, generates electricity, and economically speaking, that means we pay for the fuel and get revenue from selling the electricity. And this has been formalized in so-called spark spreads. A spark spread is an important non-standard product in energy markets. Spark spreads are cross-commodity products where the payoff is driven by the difference between the electricity price and a fuel price. For a spark spread, it's natural gas. The payoff of the spark spread at time t is St minus Kh times Gt, where St and Gt are electricity and fuel prices at time t respectively, while Kh denotes the conversion factor from natural gas to electricity. This is the reciprocal of the efficiency. So 1 divided by eta, efficiency, is Kh, the conversion factor. And this, if you think about it, is what drives the profitability of a power plant. This spark spreads. St, the price for electricity at time t, minus the generation costs, which is conversion factor multiplied with the gas price in this example. That's the short-term profit contribution. Then there is a second clean spread, which takes into account CO2 in addition to the fuel costs. So where the spark spread or the dark spread for coal just looks at fuel costs and electricity prices, the clean spread, clean spark spread, or clean-dark spread also takes into account the CO2 costs. And depending on what system you're in, you have to take into account these costs for CO2 or not. For example, in Europe, where you have an emission trading system, of course, essentially what drives profit contributions is the clean spread. The value at time t for a clean spread is St minus Kh times Gt plus ECO2 times Ct, where St, Kh and Gt again denote the electricity price St, the conversion factor Kh, and the fuel price Gt at time t. Furthermore, the clean spread requires ECO2, which is the emission factor for the fuel, and Ct, the price for CO2 emission certificates at time t. So ECO2 is the emission factor for the fuel, and it thus also has to be multiplied with Kh. Yeah, we just said, in addition to the clean spark spread, where spark represents natural gas, the fuel is natural gas, the so-called clean dark spread refers to hard coal-fired power plants, and sometimes there even is mentioned a clean brown spread, which is used for lignite plants. And clean spreads and spreads in general are traded as financial products, mostly OTC, so over the counter. Here we have a sample calculation of a clean spark spread and a spark spread. Let's assume an arbitrary electricity price St of 48.44 euros per megawatt hour electricity. Furthermore, let's assume a gas price Gt equal to 18.71 euros per MWh megawatt hour thermal. Let's assume the efficiency is 55%, that is Kh. The reciprocal of the efficiency is 1 divided by 0.55 equal to 8.82 megawatt hours thermal divided by megawatt hours electric. Thus we can calculate the spark spread, and the spark spread is 48.44 minus 1.82 times 18.71, which equals a spark spread of 14 euros 39 cents per megawatt hour electric. So producing in this particular plant at these particular cost parameters 1 megawatt hour of electricity generates a profit contribution of 14.39 euros. As long as we do not take into account CO2, that is. If we have that plant in Europe, where we also have to pay for emission rights, then we are more interested in the clean spark spread. And for that, we also have to take into account the CO2 price, assume it's Ct equal to 41.76, and the emission factor ECO2, which let's assume is 0.2011 tons per megawatt hour thermal. And then we can calculate the clean spark spread, 48.44 euros per megawatt hour electric, minus the costs 1.82 times 18.71 plus 0.2011 times 41.76 is equal to minus 0.9 euros per megawatt hour electric. So here, this may already tell us something about the question we asked up front using the example. What would we look at if we're interested in estimating whether a power plant makes profits or losses? Here we have the situation that the power plant is earning profit contributions if we don't have CO2 emission trading. But in a system here in reality in Europe, where these exemplary numbers are somewhat representative, so we have to pay in Europe for CO2 emission trading, and that means the clean spark spread for this particular power plant is negative. So in this particular hour, we would choose not to operate the power plant. Because if we operate it, that would mean the costs we have to spend in order to produce exceed the revenue we receive from selling the electricity. So a negative clean spark spread means you're not earning any revenue in that particular hour. So this is not a good sign. In particular, often if you have not a very old plant, but a somewhat new plant, which has not yet been completely paid for in terms of credit, then you have to pay the fixed costs, for example, to pay rents to the bank on top of this. So you're already not making any profit from the operation. So just comparing revenues from the electricity side with gas and CO2 costs. But my point here is, in reality, typically you pay more. You have some quasi-fixed costs for personnel, for HR, human resources. You have some other costs, and you have the bank loan you have to pay rents for. So this would hint at a not too favorable situation for the power plant. If we analyze this exemplarily for a historic time frame, here we just use the period from 2008 to 2020, some 12 years, you see that during the base period, so on average for the 8,760 hours per year, the clean spark spread in Germany for such a power plant has been mostly negative. There is just few years where this has been positive. However, on the other hand, a gas-fired power station is not built to operate 8,760 hours per year. Typically, such a power plant operates, for example, roughly between 4,000 and 5,000 hours per year, so mostly the more expensive hours. For that reason, we have also included the peak clean spark spread. So if instead of taking the average wholesale electricity price from the 8,760 hours per year, we take the peak electricity prices, defined, just to repeat, as the price from 8 to 2000 hours, so from 8 a.m. to 8 p.m. during the day, and during work days only, that price is typically higher. So here, that peak clean spark spread is even higher. And even that does not necessarily say that the power plant's revenue is restricted by this. It may be the case that even during peak hours there are some very, very profitable, and we could use those to generate, and there is others which we do not want to generate because the power plant never has to produce. We can always pick the most attractive hours, meaning in particular those where the clean spark spread is positive. So we choose to produce mostly exclusively during the hours where the clean spark spread is positive. This thus is a slight simplification, but it already gives an indication of the profitability of the power plant. There is additional complexity, as I said here on this slide. Firstly, we have averages. So in the blue line, on the baseline, the average price of 8,760 hours. However, the plant typically does not produce all these hours. It just produces a subset of the most attractive high price hours. That's a little bit more reflected in the red curve for the peak hours, but even there, given all the renewables we nowadays have in the system, even that is just a proxy for the true gas-fired power plant's profitability, because there may be other hours and the power plant may choose to operate or should choose to operate only during the most attractive hours. So that's a simplification. Second is, of course, we neglect startup costs. And then, as we said, these clean spark spreads are only reflecting the profit contribution. So other costs, in particular, human resources, repair and maintenance costs, debt costs, capital costs are not included. Furthermore, looking at any historical 10-year example does not reveal too much. It is an indication, yes, but what truly counts are expectations about the future. So if we want to assess whether we want to continue operating in the power plant, if we want to assess whether we want to invest in a new power plant, of course we will probably look at the past to get a rough idea of how the market environment has been. But what's truly relevant for our investment, for example, and for our decision to keep the plant operating is not the past, but exclusively the future. What drives revenue is tomorrow's electricity price and tomorrow's gas price and CO2 emission certificate price, not the past. And if we make a forward-looking statement, typically market forces tend to correct these spreads. Because, for example, nobody invests in new assets if clean spreads do not cover fixed costs in expectation. So as I said, you have additional costs which go beyond what's typically included in the clean spark spread. So even if the clean spark spread is positive, if it's not sufficiently positive to pay for the fixed costs of your investment on expectation in the future, you will not invest. And if nobody invests, or the other market participants do not invest either, because they all, of course, want the investment to be paid back plus interest, then nobody invests, and that will drive up prices. If nobody has invested for a few years, then due to, for example, an increase in demand, or due to, for example, other assets leaving the market, the environment is likely to get more favorable, so higher demand, less generating capacity, and the prices will rise, the prices in expectation will rise, and profitability will increase. That's what I mean by market forces tend to correct spreads. So even if the clean spark spread has indeed performed poorly in the past, the question remains, should you shut down your power plant now? So coming back to the question in the beginning of this video, assume you operate a combined cycle gas turbine and your controlling department told you, we have not been making enough money. And the implied criticism is, we should shut down the plant. Then you analyze this, if you were the person responsible in, again, either being the CEO or aiding the CEO coming to an informed decision, you would have done with probably a little bit more elaboration, a little bit more detail what we just did. Look at the profitability in the past and say, well, yes, we agree with controlling. The numbers seem correct. We haven't made, or the power plant, the CCGT, has not made an abundance of money. During some periods, it did not earn any profit contribution, given that we have to pay for labor. That may hint at a shutdown is reasonable. However, as we just said, what truly counts is the future. So now you have to make up your mind, do you expect this development to continue, or do you see better times at the horizon? And our question here is, on what basis would you make your recommendation to either shut down the plant or keep it in the system? How would you approach this? Again, please think about this yourself.